Good morning, my name is Rob Newman and I am an accountant. I work with Carter, Collins and Meyer in North Manchester. We look after owner-managed businesses across Lancashire, Cheshire and Greater Manchester. And the purpose of this little video today is HMRC as a creditor and the first warning flag facing your business of a potential insolvency. Now, insolvency is something I talk about quite a lot. I am not an insolvency practitioner. I am an accountant, but because I deal with owner-managed businesses, I see a lot of it, and particularly in the last 18 months or so, the uptake of insolvency, in my opinion and my world, has become more than it has been for the last 10, 12 years. I think it's probably the financial crash was the last time I saw as many. Now, one of the first early warning signs of a pending insolvency situation is invariably HMRC debt. HMRC debt is very tempting to get into. It's a self-managing debt in some respects. You collect money on behalf of HMRC, be that VAT, be that PAYE money, even into your own corporation tax. And you don't feel you need them, whereas you feel you need your suppliers and your rent payment and your staff and all those other things. So it's very tempting to put them at the bottom of everything and not pay them. Now, until the pandemic in 2020, I think it was late 21 before this bit actually happened, but until the pandemic, for a long, long time, HMRC were a creditor at the bottom of the list. They were unsecured, they had no preference, and you threw them in the pile with everyone else if something went wrong, and hey ho. During the pandemic, they snuck back into being important. And the reason Debenhams went bust on the particular day it went bust was so that they actually got in there the day before HMRC got a preference. And the reason HMRC have preference nowadays is because it means that they get the first lot of payments out of anything, or they get control of that liquidation or of that insolvency event. And if they get control of that insolvency event, that gives them an awful lot of power to come after you as an individual, regardless of having a limited company. So the specific process, by the way, is known as director misfeasance, and I have talked about it on other videos and we'll do again. So what is that? Those sort of warning signs in businesses? Well, one of the most obvious warning signs is it's starting to build up. You come to a quarter, a VAT quarter, you get there, you calculate your VAT bill, you put the information together, and it turns around and says you owe 10 grand. And you look in the bank account and you don't have £10,000, and you've got rent payments due, and you've got suppliers to pay, and you've got your own staff to pay, and you physically can't make that payment. Now, you may be good and try and make some payment, and you definitely do want to contact HMRC and say to them, this is the situation. It's much better to communicate and cooperate with them and come up with a proposal and a plan than it is to do nothing. In my experience, HMRC are actually quite good to deal with if you communicate. They are not the bogeymen that people often think they are, if you actually are willing to make an effort and communicate and try and do something. But you then find that you pay your staff, but then there's a PAYE bill to pay on top of it, and you don't have the money for that. And you don't have the money for paying your corporation tax. Now, this situation of not being able to pay things as they fall due is an insolvency. You are technically insolvent at that point. One of the very definitions of insolvency is the inability to pay bills as and when they fall due. And 1 or 2 quarters of this is telling you that your business is going wrong. Most likely your pricing is wrong. Most likely that you're not recovering the rates that you should do. And in one very practical example I had recently, a menswear store in Manchester fell into this. By the 3rd quarter, they hadn't paid their PAYE, they hadn't paid their VAT. They were in all sorts of difficulties and pressures. And what became very apparent is they weren't selling the stock. They'd buy a particular range of things, those things would go on the shelf, they'd sell a few of them at full price, and then they'd have to mark them down to shift them. And in marking them down to shift them, they had no profit margin. Indeed, they were actually losing money by the time that you considered the rent of the shop, the rates, the overheads, the electric, and everything else that went into it. And even at markdown prices, they still weren't shifting these things. They had cupboards and warehouse full of t-shirts and shirts and last season's gear. And the HMRC debt was the very first indicator that something was going wrong within their business. And it's a very useful sign, because not only is it something to manage and deal with and the problems that it can cause, it actually is telling you an awful lot of information. Because if you think about it, VAT is something you add on to the value of your sale once you've already decided on your price. It's not something that's included within that sale. It's never seen as your money. And a great discipline and practice to have is to actually separate that VAT money as it has. Indeed, with my own clients, I often talk them through the percentages of their sales, so that for every £100 they sell, they put £10 here and £10 there and £10 somewhere else within bank accounts, so that they never fall into this problem and hole of having the inability to pay things. And it screams at you very quickly if something's going wrong. Now, if it has gone wrong and it has happened and you are in that hole, it's essential to get advice earlier rather than later. The earlier you speak to HMRC and the earlier you speak to somebody like myself, the stronger position you're going to be in. You may be able to save the business, and many times we can. Many times we can look at new financing or changing things around or increasing prices or working out what's happening within that business. Are you selling your stuff fast enough for the right price? Many times though, the business may not be savable, but you as an individual are. Because taking that advice and putting steps in place early allows you to protect yourself against that claim of misfeasance. And misfeasance is the flavour of the month within the insolvency practitioners. It has particularly become apparent since 2020 and the pandemic. Prior to that, I rarely saw it. Insolvency practitioners may say something slightly different. They may say it's been around a long time, but as the accountant working with businesses, I very rarely, if ever, I can't actually recall ever seeing a misfeasance claim coming prior to the pandemic. And now I'm seeing them in basically every single case that arises. Insolvency practitioners casting their net very wide in order to try and claim something off individuals. I think some of that has been led directly by things like the CBILS loans and bounce back loans, and certainly I think it's being led by HMRC, putting pressure on the insolvency practices to make as much recoveries as they can. And that bar for misfeasance is quite low. It is any action or inaction that you have taken that has allowed the position of the company to deteriorate further than it need have deteriorated. Now you can see how that can be really manipulated. Possibly not the word that people would like, but it could be very interpreted. And only by taking advice early are you going to be able to ensure that you are protecting yourself from it. You're going to be able to put something in place that allows you to show that you did everything you could to manage the situation, to protect what you have there. Now, the earlier that comes in, the better it actually is. Because I can start looking at things like cash flow statements. I can start looking at things like margin protection. I can start looking at, are you pricing properly? And I can start looking at things like creating pots of money with you to show that you are doing things in place. Now, cash flow projections and cash flow forecasting is a subject for a separate video. It will also be covered in March's videos. But it's one of the most powerful things small businesses can do. And it's not a big theoretical thing. It's something very hands-on and practical. It's something that you can very much control yourself. It only takes a download of bank statements and an Excel spreadsheet and a couple of hours. It's creating a budget for yourself, just as you would do at home. Just as with your own income, you can sit down and go, well, I can spend this much on my shopping and this much on fun. It's the same thing for your business. And yet, time after time after time, I don't see small businesses do this at all. And in my opinion, without having some cash flow budget, some cash flow forecasting in there, I think you're flying blind. Particularly if you're relying on statutory accounts. Statutory accounts come once a year, invariably 9-10 months after that year end, when they're practically meaningless. So, Message for today: if you are coming up to paying for an HMRC debt and you're struggling, get advice, talk early, protect yourself, take action. Many things can be done. A lot of businesses can be saved, particularly in these times of quite high inflation. It often comes down to looking at your pricing, and pricing being one of the core fundamentals of all small businesses. Hopefully that's been useful. Look out for further videos. There's plenty on there now. We're starting to build up some momentum on these, and there's lots happening both on my own website and blog, which I write monthly, and on these videos. And don't forget, I'm on LinkedIn every single day. I post up something. Sometimes it's more whimsical than others. Sometimes it's more advice driven, but do reach out. My name is Rob Newman. I am from Carter, Collins and Meyer Accountants in North Manchester, and I look forward to speaking with you soon.